it can go a little bit more. We spoke about it not too long ago this year, breaking through 17. So, I mean, it's anyone's guess. But for the time being, today, with a budget coming up that should go through, one would think, on the third attempt, but with that political meeting over there in Washington, I think there's significant enough risk to say the coin is in the air on this rand. So I think the trajectory could be strong. It has done a lot. Remember, we were up at 19 not too long ago. So it is a difficult one to call. But it all, I think, today depends on this political meeting over in Washington, how that goes. And it's anyone's guess. Does it go smoothly? Is there a positive outcome, or does it look more like that very difficult meeting that Ukrainian President Zelensky had over at the White House? So it's a really difficult one to call. I wouldn't be putting too much risk on the event at this point.
We hope, of course, that meeting is not too terrifying. That's another pun. I learned it from the Deputy Finance Minister, by the way. He's got away with words. James, really quick one. I am out of time, but just one last question. Perhaps we make it yes, no, and if you have to quantify it with an answer, a 28 to 38 character tweet. If the inflation target is lowered, does that mean no more rate cuts? Yes, no?
No, no.
Okay. You'll join us in studio next time.
I think we can. 28 characters. I think we've still got space to cut. I think a lower target is a positive development for price stability, ultimately, but we've still got room to cut. Inflation has surprised over the last 11, 12 prints. So, yep, there's definitely space to do it. And a 25 basis point cut isn't going to de-anchor those inflation forecasts significantly.
Full stop. James? Always a pleasure. Thanks so much for your time and indulging the quirkiness in today's update. James Terp, Fixed Income Portfolio Manager and Head of Investment Strategy at Sanlam Investments. It is certainly going to be a busy and exciting day, and we continue to sort of unwire everything that you should be looking out for today. Let's go to a short break and we'll drill into those inflation numbers. Stay with us.
Ghana is Africa's largest gold producer and ranks 6th globally. Its artisanal and small-scale mining sector drives over 35% of the country's total gold output, fueling industry growth. Be part of Ghana's journey in driving growth at Mining in Motion, the premier platform to promote policy reforms, connect with industry leaders and innovators. Join Mining in Motion, where Ghana's mining growth meets opportunity.
This year's theme is particularly very important at this time of where we are with nation. With very sweeping reforms, we've seen changes in the economic landscape, and Nigeria is actually undergoing significant changes with new policies, new regulatory frameworks being introduced.
The impact of these reforms, is clearly seen now at the macro level. You can see some improvements in terms of the current account. You see improvement on the fiscal side. You see more tax revenue coming in. You see a reduction in the interest to revenue ratio. At the micro level, which is where the situation is much more complicated, and we have been calling for really accelerating whatever form of social support.
We see the digital services sector as one of those upsides, in terms of rebuilding the Nigerian economy that can actually help to unlock liquidity.
Welcome back. Drilling into South Africa's inflation basket with immediate effect. So the likes of stewing beef and minced beef and beef steak, those were the primary suspects or food groups that drove inflation slightly higher in the month of April. Not to mention the fact that hot beverages like instant coffee also soared. In fact, the price is heating more than 20% in the past 12 months. But to drill into the inflation basket further, I'm joined by Koketso Mano, senior economist over at FNB. Koketso, always a pleasure. Should we be worried about food inflation at this stage?
At this stage, we don't think that it's a big concern. Yes, it did surprise us to the upside, but we did see the uptick coming through in April. What we had learned from our agricultural economists is that there was quite a bit of pressure on cereals, margin compression as well. When you look at the producer price inflation and what suppliers were experiencing in terms of cost pressures versus what was actually being passed on to the consumer. So we had anticipated that, this would eventually reach the consumer and retail shelves. But I guess what really surprised us was the magnitude at which it came through in the April numbers. But I guess going forward, what would really weigh on pricing pressure, even at the food level, will be the state of the consumer. We know that the consumer has been doing relatively well at the start of this year, but we think that pressures will mount as the year progresses. We've seen growth forecasts being downscaled, so that will weigh on economic activity as well as pricing pressure going forward. So we don't think it will be sustained going into the second half of this year, especially when you look at cereal prices, but the pressure is there for the coming couple of months.
Right, so the headline figure, Koketso, of 2.8%, it was largely in line with most people's expectations, I imagine yours as well. You mentioned the slight, surprise from higher food pressures or food pricing this time around. I'm just wondering if there was anything in the overall report that stood out or that did surprise outside of what's happening in the food basket.
Besides the food basket, Fifi, we really didn't see much surprises there. Core inflation, which is underlying demand-driven inflation, remains relatively muted, which is something that has been ongoing for quite some time. And as I said, with weak economic activity, you can continue to expect core inflation to remain subdued. So no surprises there in terms of the numbers for April. Fuel prices, at least we get in advance. So we already knew that fuel price declines rather, were coming through in April. So not many surprises, I think, when it comes to the remainder of the basket.
I guess the overall basket, it's critical at this juncture. I mean, not only because it's happening between a week before we have our latest MPC, but because it's happening a week before we have our MPC and, recent comments around inflation targeting and the implications thereof and what it could mean. I suppose if you were one of the governors or one of the members of the SARB right now, just how would you be looking at this print in justifying a lower inflation target for South Africa and also in outlining or guiding what you're likely to do with interest rates?
Yeah, and I think putting that into context is very important, right? So it also depends what exactly what target the MPC might exactly shift towards. A lot of anticipation is around 3%. And, when we look at these numbers in context of what we've experienced in history, these are very benign inflation numbers. Even this uptick today to 2.8% is still below the bottom end of the inflation target range of 3%. So we're still experiencing relatively muted inflation, and that should be the theme for the remainder of the year as well. I mean, even when we will see inflation lifting into the second half of this year, it should remain below 4.5%. So from the context of, shifting to a lower inflation target, you could argue that this is quite an opportune time when you have, really muted inflation, because the cost of shifting towards that lower inflation target may not be as pronounced as opposed to when you're dealing with high inflation, because then the adjustment on the inflation expectation side, whether it be wage setters or wage negotiators, so trade unions, businesses, those would be quite extensive to shift from a very high inflation number to a lower inflation target. So you could argue that, from the MPC's perspective, or me being hypothetically one member of the MPC, that would be how I would think about it. And I think in terms of, the interest rates cutting cycle, which we continue to expect to progress for the remainder of this year. The timing is the issue. So we know that, they did pause in the March meeting, citing uncertainties at the global level, and that is keeping a lot of central banks quite cautious at the moment. So we might still see a wait and see approach, especially with the reciprocal tariffs only being placed on hold for 90 days going into July. So that might keep the MPC relatively cautious going into next week's meeting. But that said, Fifi, when you look at the growth numbers that have been downscaled from closer to 2% to closer to 1% currently, when you look at consumer confidence, when you look at the inflation numbers, which we got a new set of data today, really suggests that there is ample space for the MPC to continue cutting interest rates this year. The issue may just be the timing at which it happens.
With that said, while the 90-day pause on the reciprocal tariffs is in place, the 10% baseline is still there. And I mean, if I'm just reflecting, trying to recollect, so we got the 10% baseline in April, I think it was 9th of April, where the president of the US rolled back on his stance. Are you seeing any evidence at this stage or any feed through at this stage, perhaps from what's happening at the factory gate or what producers are doing with pricing, into the tariff impact on our CPI basket? Or is it still too early to tell?
We think it's still too early to tell at this stage. Even the impact of the actual tariffs, when you look at the automotive sector, for example, what we learned from NAMSA is that you could potentially see an impact coming through from the turn of the year. So it might be still too early to see from manufacturing, production, productive sector point of view, even from an inflation point of view, which will be even later to see the impact. And Fifi, maybe just to mention, the way that we're thinking about it is for the country that is imposing import tariffs, such as the United States, that's where you will see a more pronounced impact on inflation in terms of driving inflation higher. For the remainder of the countries that are also not even retaliating to these import tariffs imposed by the United States, you probably won't see as pronounced an impact on inflation, especially when you think about it in the context that you could also be leaning in terms of your supply. So say, for example, if you're shifting from the United States and trade with the United States is more restrictive, and maybe you're shifting more east, we know that China is dealing with overcapacity issues. So that might actually dampen your inflation locally, right? So if you're importing more from China or you're struggling to get your own local produce out of the country, that is something that only increases supply locally and actually could dampen inflation. So that's just the counterbalance that I think we also need to think about when you think about longer term inflation, which we think at this point could actually be have risks to the downside rather than to the upside on average.
Okay, no, good to know. Good news for the consumer. So just final parting question, budget 3.0, what will you be looking out for?
So I think as many people will also be looking out for is just how exactly Treasury manages to maneuver and plug this big gap that has been left by the reversal of the VAT increase. So that will be very interesting. I think a lot of people are pushing for Treasury to start thinking about cutting spending, instead of imposing revenue measures that are constraining on the consumer. But at the same time, it's a very delicate balance, especially when you have lower growth at the same time. So it will be very interesting to see what happens and what levers he pulls to try and plug those gaps. We hope that it won't be fundamentally on infrastructure investment, unless, of course, they manage to get more funding or participation from the private sector, which would plug some of those spending constraints. Because the most important thing is that, yes, you must balance what happens this year, and maybe you have short-term slippage on a fiscal perspective, and that should reflect in the deficit, in the debt to GDP numbers for this year. But it should be a short-term thing. So in the longer term, you still want to embed higher growth. So that means that your structural reform agenda still needs to take priority, because higher growth is going to improve your revenue generation capacity going forward. It is going to make sure that you can stabilize public finances finances, get more people into jobs, and also just make sure that you are more productive as a country, especially if you're spending on structural reform. So we hope that all of those themes will continue to come through, and hopefully this is just a short-term disturbance to the fiscal trajectory and not a long-term one. So that's what we're looking out for from today's budget.
Okay, succinctly put, Kogetso, thanks so much for your time. No, actually, did you see what's happened to transport inflation? You did mention it in terms of what's going on with the fuel price. So does that mean, given that it's a little cheaper for motorists to get around, that you'll join us in studio next time? I mean, we're not too far. I'll take that as a yes.
I did make this promise.
I'll take that as a yes. We'll see you. We will see you in June. Thank you. Done. Kogetso Mano, a senior economist over at FNB there. Let's go to a short break. When we return, I did promise you a conversation on the automotive sector, the state thereof, with a key industry player, that is VW. We've got the Managing Director of South Africa, Ms. Martina Bain, on the show right after this break.
Africa's natural capital, vast, abundant, and worth trillions, matters. Youth, arable land, minerals, biodiversity. Time to make it work for the continent's prosperity is now. Join us at the African Development Bank Group's 2025 annual meetings from May 26th to the 30th in Abidjan, Côte d'Ivoire.
Together with the Duke of Edinburgh Cup and the President's Award, there's a lot of initiatives on the table in terms of assisting youth, and not only from an educational perspective, but also from a skills development perspective.
Company philosophy, we're concerned about people, not only our client, our business partner, our colleagues, but also the community. That's why DOE, of course, is one of our major partner for charity.
The whole thing was really devised with the idea that if they could start the program in various countries, mainly starting with the Commonwealth, could they then offer the program to children that came from, less fortunate backgrounds.
Education is a key component of what we do. So in order to be able to provide that, we have a team of analysts and educators across all of our offices where we have content from those who are newbies to those who are advanced.
Welcome back. Now, South Africa's automotive industry has been quite topical of late in driving conversation about what the implications, a serious fallout with the US could mean for growth in the sector as well as jobs. According to data compiled by Aluma Capital, South Africa exported about 71.5 billion rand worth of goods last year, and the automotive sector accounted for almost half of those that were exported, around 47% or so, and that is under AGOA. But to discuss the state of South Africa's automotive sector and its outlook amidst trade uncertainty, I am joined by Martina Bain, the Managing Director for VW South Africa. Ma'am, thanks so much for your time. By all scores, or if I use the market as a barometer, there's a whole lot of confidence right now about how trade talks potentially could go between President Ramaphosa and President Trump. We do have the JSE at record highs. rise. We've got the rand below 18 to the US dollar, and you've got optimism that things could be sort of not as bad as feared. I suppose it's then a question to you, representing the automotive sector that has been so topical in a driving conversation about what the future of AGOA and South Africa-US relations could be. Are you feeling as confident about the prospects of those discussions, ma'am?
Well, I hope it materializes what President Ramaphosa says, that he is very confident. I mean, I don't have really any insights into how policies or how politics will evolve, but definitely any additional trade barriers or any won't help. It doesn't matter whether it's now under AGOA or Europe or China or whatever. So I am optimistic and confident that this is globally seen, that we'll need rather free trade or open trade than trade barriers.
With that said, ma'am, we're having this conversation whereby it is in the aftermath of some tariffs that were placed on the automotive industry globally. There's some 25%, and then afterwards we had a 10% baseline and all that. We have seen some of the repercussions on global players, auto players in the sector, even yourself specifically, ma'am, or VW specifically. I guess it's a question on your reflection on the current state of South Africa's automotive sector against uncertainties around trade, but also against other operational matters right now, like perhaps the cost of energy. I see that there are talks about a possible strike in the sector also ongoing. Just balance that for us in terms of how things are looking.
So I think as South African automotive industry, we face 4 challenges in the global scope of things. So first of all, export markets for the South African industry, and the South African automotive industry heavily relies on exports still, because the domestic market is not big enough to maintain us, or did not grow to that extent as we were all hoping, and as the South African Automotive Master Plan was forecasting. So we are all facing export challenges for different reasons. So the one is, of course, as you've mentioned, AGOA. The other one is, and that is, for example, for us very challenging, is the export volumes to Europe will come under risk, because Europe is transitioning to electric vehicles. And in the absence of an electric vehicle policy in South Africa, we probably would not be able and would not be the #1 manufacturing hub for electric vehicles to export to Europe. So there's export risks from many sides. It's AGOA, it's for us, for example, Europe. What we then see, and that then talks more to the domestic market in South Africa, is that the domestic market becomes more under risk in terms of imported cars. So apparently the increase of imported vehicles towards locally manufactured vehicles is something we'll see critical as an industry and as manufacturers in this country. So we don't want to become an import replacement market. We want to manufacture cars relevant for the domestic market as well. And one of the reasons you mentioned is, for example, costs of manufacturing in South Africa, as opposed to apparently costs of manufacturing in other destinations, which probably have not been on the cards 20 years ago or 15 years ago, but are now coming into the market. And I'm not only talking China; it can also be India, it's Thailand. So we'll need to have a look at that. We don't have major investments, only very few additional investments. Localization is not progressing to that extent as we planned it. So we need to, as an industry, together with politics, make South Africa a compelling investment destination for automotive in the future again.
With that said, ma'am, amidst all this uncertainty, some of the colleagues in your industry have been saying that if South Africa doesn't get AGOA, and if it indeed is a done deal, it's okay, because we've got the rest of the African market to potentially exploit. under the AFCFTA. And I just wonder if you share those views, whether, you know, the loss of AGOA won't be as material given the potential opportunity under the AFCFTA, or whether the loss of AGOA could mean serious consequences for the outlook of the local auto industry here in South Africa.
So, in fact, I think there's only one of the manufacturers in South Africa trading under AGOA currently. So, under AGOA currently, I won't say it's not a major train smash, because for this one manufacturer, it will be a major train smash, definitely. And in general, I think it's not a good sign towards trading or global trade. For us, we are not trading under AGOA, so it currently doesn't hurt us, just the ripple-on effect if our suppliers then are affected. Definitely, and that's I mean, I'm driving that. I'm very passionate about the African potential, the AFCFTA. I think when you talk to us specifically in the volume manufacturing space as manufacturing in South Africa, we all are keen. We all see the huge potential under the AFCFTA of the African market, but it's not. There will be a lot of work to be done to unlock this potential in the market, and that is policy work as well, which we do as an African Association of Automotive Manufacturers. So yes, that will be in the future number 2 source of selling cars. Number 1 will probably be South Africa, specifically in the volume space. But a lot of work to be done and a lot of support needed there as well in the policy space to leverage that potential.
Okay, so I can mention the player that is trading under AGOA. I believe it's Mercedes-Benz and I believe BMW as well, but I stand to be corrected. I suppose just one last related question, ma'am, on the trade dynamic and the tariff situation. What is that going to mean for costing of cars? Because I imagine that the entire supply chain is also impacted by this in terms of parts and all that. Is it going to materially impact the cost for the consumer in driving or choosing to purchase a car, including a VW, ma'am?
I don't see that too much. So, and I'm speaking under correction, of course, for other manufacturers, because we also don't source parts from the US to build into locally manufactured vehicles in South Africa. The only thing I can currently see for us is if we share a lot of suppliers because of the small size of the industry, the manufacturing industry in South Africa. For many suppliers, it's not viable to be exclusive for one. So, and that's a good thing. So we'll love to share them. But if on the supplier side, local South African supplier side, now volume is falling apart because of AGOA trades, and I can imagine at least one of our suppliers who is also manufacturing for someone trading in the States, that might be an effect. But I don't think driving or buying a car or leasing a car will be more expensive. Let's see what it does with the petrol prices. But I don't see an immediate effect for automotive as it stands now.
This is good to know. As VW, are you impacted in any way by what's happening with ArcelorMittal? And their long steel business and the potential, unfortunate case of that business not continuing as a viability?
Also not directly impacted from a localization perspective, which I find a sad story. I think I would love to purchase more local, but in this case we are not affected. Because from a specification, unfortunately, we are not able to use African steel because the specification does not qualify for our products. I would love to, in the future, specifically also in the light of the African Continental Free Trade Agreement, would love to work with steel producers in Africa to get the specification for automotive industry in place that we can purchase African steel. So in this case, fortunately, I'm not affected, but it's another chapter for South African industry, of course.
Absolutely, and a really interesting take thereof. Hopefully a follow-up conversation, and hopefully there will be developments soon around EV policy, and we'd love to get your take on those developments. But Martina, we'll leave it there, ma'am. Thanks so much for your time. Martina Biene, the Managing Director over at VW South Africa. Parking, the conversation. Going to a break, of course. We discuss energy and water security when we return. Stay with us.
Africa's natural capital, vast, abundant, and worth trillions, matters. Youth, arable land, minerals, biodiversity. Time to make it work for the continent's prosperity is now. Join us at the African Development Bank Group's 2025 annual meetings from May 26th to the 30th in Abidjan, Côte d'Ivoire.
Our partnership with the Ministry of Environment and Loma is built on a clear objective. It is about achieving zero waste to landfill. We believe this is possible. And with today's milestone, it indicates a great journey ahead.
As a state, we're aiming towards zero footprint, carbon footprint. And what we are about to do today ticks the box for us.
Our responsibility is to collect the non-recyclable, combustible non-recyclable waste from the dump sites and industries and then use them as alternative fuel.
Welcome back. As promised, just sort of drilling into the energy sector as well, or diving thereof. Africa's power, water and energy future currently under the spotlight at a major industry-related conference in Cape Town, South Africa this week. The focus, of course, comes as the world continues to evaluate what the withdrawal by the US from the Paris Climate Accord could mean for sustainability and the just transition. We discuss further with Darosh Maharaj, Executive Head for Engineering, Infrastructure and Mining for Business and Commercial Banking over at Standard Bank. Darosh, thanks so much for your time. So what is being said around matters around sustainability in this climate by yourselves as well as by your delegation of clientele that you have brought to Cape Town?
Good afternoon, Fifi, and thank you for inviting us to the show, and thank you to the listeners for tuning in as well. Another fascinating installation of Endless Africa this year. I think that, the narrative around energy and water particularly is gaining momentum and focus, particularly as it relates to sustainability. What we're seeing is a lot of enthusiasm, a lot of energy. We often talk about the need for collaboration, and as we go year on year, from conference to conference, it's just a stronger narrative that's developing. So very, very positive sentiment and a lot of energy in the space. I think that what's becoming very clear is, especially with all of the knowledge sessions that are being shared, there's a lot of buy-in that's developing around the need to start proactively addressing the water environment. Energy is still fairly new, but we've made a fair amount of progress relatively. And what we're trying to take away from that are the learnings that we've seen from the energy space and trying to apply it to challenges that we know will come up in the water space. So those are some of the key themes, but very positive thus far.
No, fantastic. And I mean, if we're applying lessons from the energy space is anything to go by, lots of lessons there about how a turnaround can potentially be put forward. And definitely lots of sharings that can be translated into water, which many people are citing as a major crisis right now. But if I look at what the Standard Bank Group is trying to do in terms of sustainability, you have stated your intention to mobilize around 450 billion rand in sustainable financing by 2028. I guess it's a question specifically then, Darash, around what the thinking is with water and, you know, the opportunity that you are seeing in financing the space and also some of the risks.
Vivi, thanks for that question. It's a good question. So for us, that it definitely links into that picture. Water, if you think about sustainability, water is one of the critical sustainability development goals, and you have to look at both ends of the spectrum. So when you look at the utility side and you look at the large infrastructure projects that require support and require the banks to get involved, there's definitely support that will be forthcoming from us. And then on the other end of the spectrum, which is particularly focused on the market that I'm responsible for, which are the small to medium enterprises, we're also looking at, as that transition happens and as we scale up on the utility side, the challenges that businesses will face in the interim are very real, and businesses can't sit that out. So we're looking at how to support those businesses as costs start to escalate in the water space, and climate-related pressures are placed on businesses to manage their water more effectively. And I think it's also an important factor to look at small to medium enterprise, understand their challenges, and ensure that we have the requisite solutions available to them. And solutions, as you know our narrative, we look at full value chain. So it's not just the funding, it's understanding who provides those solutions, who are trusted partners that our clients can deal with, and making sure that we can connect those dots for them.
Absolutely. Darash, we certainly look forward to sort of tangible outcomes in terms of possible deals, particularly for those smaller and medium players in the sector as a result of the conversations that are taking place. But we'll leave it there for now. So thanks so much for your time. Darash Maharaj, Executive Head for Engineering, Infrastructure and Mining over at the Standard Bank Business and Commercial Banking. About 1 hour away from hearing from the Finance Minister here in South Africa. As you know, the Budget 3.0 will be taking place, and by all accounts, it could be the last one for this year. Of course, South Africa's fiscal position will be closely monitored and watched when the country's finance minister does table the third iteration of that budget after the previous two failed over a lack of support. Remember, this budget coming after ratings agency S&P retained South Africa's current rating as well as outlook, and that's despite all the fiasco around the budget. However, as we have heard from James a little earlier, as well as Koketso, investors are going to be looking out for how the minister will plug the 75 billion rand hole, while also budgeting for growing the economy. I'm joined by Annabelle Bishop, a chief economist over at Investec, for more. So we're about an hour away, Annabelle, of hearing most likely what, in your view, in terms of possible amendments that the minister will present, the finance minister, that is?
Hi, Fifi. So probably quite a few amendments. We expect there to be some cut in expenditure. The minister's highlighted that as a possibility, something they're looking at quite keenly. But also, Fifi, interestingly, a cut in the inflation target. So it's not certain it's going to happen in this budget, but the finance minister or the deputy finance minister certainly indicated something near. And, you know, that obviously is very positive for the rand. We've seen the rand strengthen ahead of the budget already. Expectations are not for higher borrowings, although, of course, the GDP forecasts will be altered. As you know, they've been moving around this year, and that in itself will have a little bit of an impact on the GDP rate ratio to debt for last year, and of course looking forward to this year. But mainly we think that they're going to focus on really trying to lift revenue collections going forwards.
I mean, on the inflation targets, we have heard quite a lot of commentary around that. We've seen the Rand react positively to statements from the Treasury that an announcement would be forthcoming soon. I mean, as soon as around 2 o'clock today, fantastic. But what do you reckon the likely move will be? I mean, are you on camp 3%, as I've heard others? And in that event, what do you reckon that does for the outlook of interest rates in monetary policy?
So that's an interesting point. You know, if we do get the inflation revised down, obviously it depends by the inflation rate target revised down. Obviously it depends by how much. And, you know, currently the midpoint is 4.5%. If they drop it to, for example, 4%, then the inflation range obviously is 5.5% to 2.5%. Then, you know, if the Reserve Bank's looking at an inflation forecast next year of 4.5% and the following year of 4.5%, then that would start to make interest rate cuts unlikely for this year if they don't drop down their inflation outlook. Look, inflation has been coming out lower than the Reserve Bank has expected. Of course, we got the inflation figures out today again, and they are still below 3%. Now, the Reserve Bank targets on a forward-looking basis, and of course, as we know, National Treasury sets the target, and the Reserve Bank is required to achieve it. So where we sit at the moment, there's a risk that we might not see any more inflation, any interest rate cuts led by inflation this year, if obviously they do drop the target significantly. But again, we don't know when those changes are going to come to the inflation target.
Sure. I mean, some are also saying, Annabelle, I mean, the fact that this budget is taking place when the president of the country is not in the country, it bodes well for it likely passing through this time around. Of course, President Ramaphosa being in Washington, I imagine that the finance minister will reflect on the global environment and also our standing with our international partners. Just your thoughts and what kind of feed-through you are expecting or that we could see from the situation in Washington right now?
So I think, first of all, in the budget, there has been reported that there's been a lot of communication between the political parties and the government of national unity, and that they have essentially reached broad consensus on the budget. So from that perspective, that when they go to Parliament and they vote on the budget, there should be support coming from the different members of the GNU. As you know, the DA voted against the budget last time round, and obviously they're quite a large part of the government of national unity. So I think that's an important point first. Looking at the actual trade negotiations, we think that the president, along with others in the delegation, will try and look at a good trade deal for South Africa. So far, countries around the world have been fairly successful in negotiating with the United States to bring down the initial tariffs threatened to be imposed. As you know, there was a 90-day pause, and now we're in a negotiating period. There's little reason why South Africa shouldn't be able to bring down the hefty tariffs imposed or potentially to be imposed on us as well. And certainly, you know, South Africa's got a lot to offer in terms of our motor vehicle and agricultural exports, among others as well. Even though many minerals are exempt, that's also key for the US. So we think there could be some good progress in the talks, and we think in general there's probably going to be quite a bit of information sharing and hopefully a strengthening of ties between what is one of South Africa's key trade partners.
Actually, that's such a great observation, and I suppose it's a great barometer also for us to use in terms of tailoring our expectations. The fact that other heads of states that have gone to the White House, most of them have come out with a positive outcome. Of course, they haven't been under the spotlight in terms of being accused of genocide and very, very bad things happening in the country, but maybe we'll take your point of view in terms of the positive outcome of others, translating into a possible positive outcome for us. Annabelle, unfortunately, we are out of time, ma'am. I hope to talk to you on the other side of the discussions, I'm sure. Annabelle Bishop, Chief Economist over at Investec, helping us wrap up Power Lunch Southern Africa today. Look, your closing bell is going to be as busy, if not even more busy than Power Lunch Southern Africa was. Of course, you'll be reflecting on the budget, but a whole host of corporate announcements that came out. Southern Sun coming out with its results, higher earnings on that front, and also doubling its dividend. A trading update for Roynet. In fact, the stock was down over 8% at one stage. It's clawed back some of those losses, but also guiding that its earnings would be lower. Positive developments regarding the multi-choice Canal Plus deal. Of course, the competition authorities here in South Africa recommending that that deal be approved with conditions, of course. It's actually been about a year since that deal was announced. So positive developments there on the side of multi-choice, and of course a whole lot more. So do make sure that you tune into Closing Bell Southern Africa. But for now, leg stretch a bit maybe. coffee really quick because Power Lunch West Africa is coming up right after this short break. We'll do it again real soon. Thanks so much for watching. Bye-bye.
Weekly reports from Rwanda's rapidly developing economy. Explore new advancements in energy, agriculture, health, entrepreneurship, and more. Stay connected to the business pulse of Rwanda with Doing Business in Rwanda. Each episode bringing you the latest developments, insights, and opportunities shaping the nation's future. Only on CNBC Africa.
Africa stands at a crossroads. A thriving, transformed economy is within reach, but one factor remains a game changer: gender equality. But how are they connected? And what can we do to ensure progress for all? The 2025 African Transformation Report explores these questions, offering insights, challenges, and solutions. Women often face limited access to education, capital, and economic opportunities. But these are not just women's issues. They're economic roadblocks with staggering costs. The message is clear. Gender equality isn't just about fairness. It's an economic necessity. When women thrive, economies grow, and entire societies benefit. The 2025 African Transformation Report provides the roadmap. Are we ready to take the next step?
Hello there and welcome to Power Lunch West Africa, as we bring you some of the latest developments in the West Africa region today. I'm Kenneth Igbomo, and we are going to be dissecting the biggest stories on the West Africa region today. Quite a lot has played out in West Africa over the last 6 months. We'll be looking at the risk outlook for West Africa, as Pangea Risk believes that ECOWAS is entering a period of sustained fragmentation. Still on the show, we'll discuss some of the market sentiment as Nigeria's Monetary Policy Committee held rates steady on Tuesday. And finally, we'll wrap the show with a survey by Deal Room that lists Lagos as the world's sub-emerging tech hub. You can join in on all our conversations by sending your thoughts to our handle, that's at CNBC Africa on the X app. Use the hashtag PLW410 when we do so. And we're also making it even easier for you to stay connected. Reach out to us on WhatsApp. The number is +270 605015 But before we get into the conversations today, let's catch up with some of the headlines from the West Africa region at this hour. We start from Nigeria, where the private sector under the Manufacturers Association of Nigeria and the Lagos Chamber of Commerce and Industry are urging the Central Bank of Nigeria to cut the benchmark interest rate significantly to reflect current realities and ease the credit burden on manufacturers, or present a clear signal of possible future easing. The private sector players believe that the current monetary policy trajectory risks turning banks into vaults of idle wealth, while the real economy faces suffocation. In other news, the Pan-African Multilateral Financial Institution, the African Export-Import Bank, has reported a 4.5% rise in its net interest to $411 million in the first quarter of 2025. According to the bank, the net income grew by 21% to $215 million, while the group's total assets and contingent liabilities increased by 6.4%, reaching $42.7 billion. Shareholders' funds increased by 3.4%, reaching $7.5 billion, driven by strong internally generated capital. Onto commodities, oil prices are up by more than 1% in early trade as supply disruption fears mount over reports of a possible strike on Iranian nuclear facilities by Israel. Brent crude futures rose by 79 cents to $66.17 a barrel, while the U.S. West Texas Intermediate crude gained 82 cents to $62.85 per barrel. And these are some of the top stories making rounds at this hour. For more market news and insights, you can visit our website at www.cnbcafrica.com for more stories. To our first conversation on the show, where analysts at Pangea Risk say that issues like the alliance of Sahel states with Russia and China and institutional gaps emerging in ECOWAS policy enforcement to restore cohesion and governance standards is driving the West African region to a period of sustained fragmentation, with limited prospects for unified strategic direction over the coming year. Bilal Basuni, head of the risk forecasting at Pangea Risk, joins me now for this conversation. And thank you so much for your time today. And I'd like you to clarify your outlook here, starting first with what we're seeing play out globally and how that is shaping sentiment here in West Africa.
Thanks for having me, Kenneth. So the function and identity of ECOWAS, specifically given the geopolitical shifts and particularly also from the realignment from a few countries towards Russia, particularly Burkina Faso, Niger, and Mali, has created an identity crisis within ECOWAS, and we believe that it is turning into a status of flux. Particularly the bloc's enforcement mechanisms have proven so far inadequate, and its capacity to mediate intra-regional disputes or even enforce compliance is becoming more and more constrained. So now with formally these three states that we've mentioned departed, there's no credible pathway for reintegration, and a diplomatic stance that is currently becoming more and more disruptive is becoming also quite difficult to avoid confrontation within the bloc.
All right, we'll get into the intricacies of what this structural shift means for ECOWAS, but I'd like you to start by talking about how this will impact integration efforts around dealing with security and even other issues like the AFCFTA.
So in terms of security, as we know that the alliance of the Sahelian states has primarily shifted towards decoupling from ECOWAS, and one of the main reasons was the security aspect. Now, and the security has continued to degrade over the past few months. In fact, we've seen an uptick in the number of attacks that all of these three countries have been suffering, and a big proportion of the of the land has been in fact been lost by, particularly in Burkina Faso, towards the insurgents that have really capitalized on a lot of the security vacuum that has grown and has not improved. Interestingly, as I mentioned, that the AES has positioned itself decoupling from ECOWAS to try and mitigate a lot of the security threats, which they have now really struggled to do so. On the other hand, looking at intra-African regional integration, it makes the situation even more complicated than before. Even with Nigeria, for instance, gazetting tariff concessions over the past few months, formally eliminating duties on 90% of intra-African goods. This move establishes again Nigeria's trade orientation as continental rather than regional, but this recalibration is partly pragmatic within intra-ECOWAS trade, because of how much the trade levels are quite low, below than 12%. And political consensus within the bloc continue weakening.
All right, I'd like to get to the issue around the economic decoupling, like as you rightly put it there, from ECOWAS and from these states, especially how it affects the AES autonomous currency, and what pathways do you see for that currency in the near term?
So we're already seeing monetary policy contradictions already surfacing. The AES states remain formally inside the WEMU, which means that they're still using the CFA franc and reliant on the regional central bank for monetary coordination. Yet all three governments have floated plans to issue new currency, potentially backed by strong mineral reserves that these countries have, and tied to a future AES central bank. But the contradiction really lies here in implementation logistics and institutional sequencing, which is quite important. So the CFA franc offers monetary stability, currency convertibility, but also, importantly, access to regional liquidity channels. So none of those functions can actually be replicated in the short term if the AES proposed structures continue. Additionally, also within the West African Monetary Union, the macroeconomic convergence criteria, and if the AES departs from these rules while still within the system, it creates very difficult and important legal and financial ambiguity.
Because now we're seeing that these states have imposed a 0.5% import tariff on the rest of the region. And I'm trying to imagine here in terms of that, talking about managing the structural shifts, you're looking at the infrastructure side of it. Because we're looking at the ports makeup here in this region, we're still seeing that these countries rely still heavily on other ECOWAS countries, on the ports from the other ECOWAS countries. And just how exposed would they be to likely retaliatory trade restrictions?
So I think it's useful to think of these 0.5% import tariffs that have been imposed in April as more of a symbolic gesture than actually anything structural, particularly from the AES side. On one level, it introduces a policy distinctions that disrupts the ECOWAS trade liberalization scheme, which has been part of the identity of ECOWAS for a very long time. And also reframes regional economic norms around, again, a self-identified AES agenda. Yet the size of the tariff is quite modest and exemption limited, which suggests, again, that it's quite symbolic in its nature, rather than extractive or structural. Also, the timing of it was quite strategic. If you remember, it was just imposed ahead of the ECOWAS 50th anniversary summit, and shortly after the formal withdrawal of the bloc from ECOWAS in late January. So it amplifies the message of economic sovereignty without actually collapsing existing inter-bloc trade. Now, in the event, which is not our baseline view, that there's retaliatory trade restrictions by ECOWAS members, given that 92% of the import cargo transits through ECOWAS, as you know, this dependency will create material and very profound vulnerabilities to any coordinated countermeasures, especially if port access, custom clearance times, or licensing become politically leveraged. Again, this is not our baseline view. We believe that ECOWAS states are taking the moral high ground in many of the engagements with the AES and trying to avoid escalatory measures that can become tit for tat.
Yeah, but then that would say a lot about the influence ECOWAS has on the region. And very quickly, in one word, I'd love to get a quick answer on this. Would you say that ECOWAS is now more or less a broker or a bystander in the region, or a relic?
Yeah, so ECOWAS is slowly drifting into a role that is largely symbolic at this stage. And it continues to host summits, publish communiques, and facilitate technical cooperation in areas such as health, migration. But its strategic levers and leverage that once defined it for a very long time, especially around security coordination, trade harmonization, political norm setting, are weakening. And is likely to continue to do so. The bloc currently oscillates between broker and bystander, as you mentioned, rarely asserting enough to be either decisively. So without structural reforms or assertive policy recalibration, which is unlikely in the short term, it is on the track to function more as an intergovernmental forum than an integration vehicle.
All right, and thank you so much for your time on the show today. Bilal Basuni there, the head of risk forecasting at Pangia Risk, talking about developments here in ECOWAS and the outlook for the rest of the year. We're going to take a quick break. Power Launch West Africa will be back in just a moment.
This year's theme is particularly very important at this time of where we are with nation, with very sweeping reforms. We've seen changes in the economic landscape, and Nigeria is actually undergoing significant changes with new policies, new regulatory frameworks being introduced.
The impact of these reforms, is clearly seen now at the macro level. You can see some improvements in terms of the current account. You see improvement on the fiscal side. You see more tax revenue coming in. You see a reduction in the interest to revenue ratio. At the micro level, which is where the situation is much more complicated, and we have been calling for really accelerating whatever form of social support.
We see the digital services sector as one of those upsides, in terms of rebuilding the Nigerian economy that can actually help to unlock liquidity.
Welcome back. If you're just joining us, you're watching Power Launch West Africa. So move on now to our next conversation, where Nigeria's Debt Management Office is set for a 500 billion naira treasury bills auction today as investors' appetite for money market instruments rises. On Tuesday, the Central Bank of Nigeria held an OMO auction and offered 500 billion naira after the 1.1 trillion naira maturity. Traders at Access Bank expect a calm market as investors position for next week's bond auction. Tobichukwu Ikpe, the Treasury team at Access Bank, joins me now for a market update. Thank you so much for your time today, Tobichukwu. And I'd like to first start with what we saw play out here with the MPC decision here. And I'd like you to speak to what rates at these levels will mean for the market down the line to the next meeting.
Hi, thank you for having me. So, as you saw yesterday, the MPC held up parameters stable. That was in line with market expectations. There was no need to do a rate cut at this time because the inflation trajectory is not yet downward, it's firmly downwards as market participants will expect before they can start a rate cutting cycle. So their stance and tone right now is just a wait and see approach. When the next couple of inflation numbers come out, if the trend continues to be downward, then we might see the interest rates start to reduce. But for what it means in the near term, it means that we've come to the height of the hiking cycle. So that spurred bullish sentiments in the bond market today as market participants are starting to buy up all their available bonds with the expectation that there will be no more interest rate rises in the medium term.
But looking at the liquidity management in Nigeria here, and I'd like you to speak to what we're seeing play out with those OMO auctions here, with the recent offering here, and what does the current bid to cover ratio and stop rate signal?
It signals that there is ample liquidity in the system. The CBN last year did a lot of monetary tightening via the OMO auction, so they mopped up a lot of liquidity out of the system, and we've seen some of those maturities start to come back. Yesterday we saw 1.1 trillion mature, and they floated 500 billion, so 655 billion. So they will need to maintain that the pace of those OMO auctions because there are still more maturities coming in May and June. For example, next week there is a maturity of about 980 billion. So we expect that there will be another OMO auction soon just to manage the liquidity levels in the money market system.
All right, now it's good to talk about that, talking about the near-term liquidity preferences and what we can expect. But what's your view on the investor risk appetite?
The investor risk appetite for the last few days has been largely muted, given there's no volatility. But last week, given the improved macro sentiment, that's what has been driving investor appetite recently. We have not seen anything on the local side has really changed much. The local tone is largely stability. So when the macro risk appetite improves, when there's a risk on sentiment, generally, like last week after the trade pause between US and China, we saw bullish sentiment in the fixed income space last week and also some in the FX space. So the macro sentiment is generally what's driving sentiment here. For the local market, stability is the key word. And investors just continue to cherry pick. They will continue to buy up fixed income securities where they feel comfortable.
But in terms of how are they positioning then for the bond auction next week?
In terms of positioning for the bond auction, we expect appetite to be there as well. They are comfortable at 20% levels. That's where bids are on those on-the-run bonds. Well, we expect the bond auction to close at similar levels next week as well. So it's up to the DMO what they want to sell, but we will see, given that they are raising a sukuk this week as well, so we might not see them borrow much at the bond auction. So wherever rate they close, that will give an indication of where the trajectory of rates is going forward.
All right, interesting times ahead, but thank you so much for your time today. Tobichukwu Ikpere, the Treasury Team member at Access Bank, talking about fixed income and FX market here in Nigeria. Moving on to our next conversation, where Lagos has been named as the world's top emerging tech hub after recording increasing venture capital, startup value creation, and growth. A new Deal Room Global Tech Ecosystem Index shows that Nigeria's commercial capital, Lagos, is challenging the Bay Area, China, and Europe as the future hotbed of tech innovation. Yoram Wingard, the founder of Deal Room, joins me now to unpack this survey. Thank you so much for your time, Yoram. And let me just get a sense of the key findings of this index and the report and what it shows in terms of what Lagos has to offer the world.
Yeah, so we just released a global ranking of startup and venture capital ecosystems, tech ecosystems. It has 3 rankings, one where the Bay Area is the #1 ecosystem in the world by sheer size. It's also the oldest tech ecosystem. It started 40 years ago. There's now a new wave of tech ecosystems rising. A couple of years ago, perhaps it was in India, there was really the hotspot, and now it turns out to be in Lagos. So the ranking shows that Lagos is one of the fastest growing ecosystems measured by kind of value created by venture-backed startups, mostly in fintech.
All right, well, in terms of what this broadly means for the larger African cities here, are we seeing signs of a regional spillover effect here?
A regional spillover effect? I mean, it's a good question. I think what we're seeing is rapid adoption of software that is being developed by Nigerian entrepreneurs, and that's seeing wide adoption. And I think that Nigeria is actually very suited for this kind of rapid adoption. You don't have these massive incumbents. There's still significant informal economy, and so that's perfect for actually leapfrogging into this new digital era. And that's why you're seeing the emergence of massive fintech companies that could potentially become even bigger than fintech companies that you might see, for instance, in Europe, because Europe is really dominated by large incumbents, by traditional institutions that are really kind of dominating society. And the benefit that Nigeria has, it doesn't have that. So you might well see one of these fintech companies become very, very big, as we have seen in China and also in Brazil and also in other parts of the world.
Let's talk about some of the other cities in sub-Saharan Africa that featured on your index. And South Africa, yes, we're seeing Cape Town and Johannesburg. I'd like you to speak to that as well, what we're seeing in terms of the offering from East Africa.
Yeah. So let me just pull up because we've created an interactive tool. So Lagos is the number one. It's followed by Cairo in Egypt. So Egypt, I guess that's not sub-Saharan, but also in Africa. Followed by Johannesburg, Nairobi, Cape Town, Accra, Kampala, and then Dakar. And actually the entire sub-Saharan African region is very much kind of considered the next big thing when it comes to venture capital and startups.
Yeah, but in terms of how this compares with the rest of the world, yes, 158 million, still really low when compared to the numbers you're seeing come out from areas like the Bay Area. And I'd like you to speak to what then needs to be done in terms of achieving scale and depth and larger volumes.
Yeah, I think it needs this new industry that's coming out of the region. You're seeing pretty significant companies being created. So the total enterprise value that's now created by VC-backed companies in Lagos is $15 billion, which is reaching critical scale. And I think this should be a wake-up call also for the government that this really could be the way for the diversifying the economy. The economy is still, of course, very reliant on natural resources, and that's like a really solid foundation. But at some point, you want to diversify, of course, your economy. That is already happening, but I think that these new generation of tech companies could play a massive role in making that happen. And you could see, again, some of the biggest tech companies in the world could very well come out of Africa due to the size of the continent, just the sheer number of people, and the fact that you don't have these large incumbents that are blocking innovation.
Talking about the new generation of tech companies here now, and I'd like to bring in the AI edge here. And to what extent are we seeing a rising of AI companies on the continent compared to the rest of the world? Are we seeing the type of traction that Africa needs to be more to be competitive at that level, or do we risk being left behind in that area?
Yeah, so the main wave of tech companies is like I said, it's more in fintech, so it's not really AI. However, I wouldn't necessarily worry that you will be left behind in this wave, because what we're actually seeing is a rapid commoditization of AI. This is a scientific discovery that, yes, it has been kind of spearheaded by US and Chinese companies, and in that sense, yeah, the rest of the world is left behind when it comes to really being at the cutting edge. But in the end, I think the benefit will spread, and this is a widely available technology, just like flying 100 years ago, so this will benefit everybody, and it will also permeate services in Africa, no doubt. A lot of models now, open source is really being embraced by the AI community. So this is going to be widely available and not something to necessarily worry about.
All right, thank you so much for your time on the show today. Yoram Wingard, there, the founder of Deal Room. And it's a wrap on today's edition of Power Lunch West Africa. You can visit our website at www.cnbcafrica.com for more market news and insights. Join us live at 2:30 p.m. West African time later today for Closing Bell West Africa. I'm Kenneth Ibomo. From me and the team, it's bye for now.
Africa's natural capital, vast, abundant, and worth trillions, matters. It is the strong foundation to raise Africa's future with dignity, resolve, and ambition. The youngest continent, the workforce to power the world. Vast arable land to feed Africa and the rest of the world. Massive reserves of minerals and
I'm a journalist. I tell stories. I tell African stories every day. Someone say to me, oh, hello, Mr. Intra-African Trade. In part because I think it's a story that fascinates me. It's a story, I think, for me that also crystallizes the dream that was started in 1963 at the formation of the African Union. 1963 is special for me because I was also born in 1963, and I therefore tie in very neatly, if I may say so myself, with the goals of the African Union as we know it today. As indicated, we're going to start off our program very shortly with a scene setter, and that's going to be done by Ms. Ellen Asimwe, Deputy CEO, Trademark Africa. Just a quick note on what Trademark Africa is for those who may not know. It is an African aid for trade organization founded in 2010 with a mission to grow intra-African trade and increase Africa's share of global trade while helping make trade more pro-poor and environmentally sustainable. Now, at the moment, it's expanded in recent years to cover 14 countries across East and the Horn of Africa, as well as to Southern and West Africa. With that, may I invite Ms. Asimwe to come and address us, please. Thank you.
I was asked to set the scene of the no-store borders or the digital trade borders for Africa. With the global shifts that we're seeing, with one sneeze from the US and the whole of the world, not just Africa, the whole of the world is trembling. And people are asking, but Africa, we are actually only 2 or 3% of the global trade. Should we be bothered? Should we be affected? Yes, we should be affected because the fact that we are very small in this trade, any little shift, any little wave is likely to wash us over. So we have to get prepared. And I'm so heartened to know that the ministers of trade were in Kinshasa and have come up with an action plan. Because it's been said this morning, and it's been said all the time, digital will help us leap forward. But we can't leap. We can't talk of leaping forward if we don't have the foundations, as we've spoken, and if we don't put in place the appropriate structures, digital structures and infrastructures. But then it's such a precocious moment because time cannot wait for us. At Trademark, we have worked in this sector for 15 years, putting in place the building blocks for what we are calling no-store borders now. It's been painstaking, it's been slow, it's been worthwhile, especially in Eastern Africa. In the last 10 years, and our founder, Frank Matsat, is here. He was our founder at Trademark, and now he's with TBI. He led us to develop over 100 single SWIFTs, what we call single windows. You know, for you to build a no-store border, you have to first automate and digitize institutions at a country level. If you go to West Africa, there are some institutions that are still using typewriters. Others have moved on to, of course, advanced technologies. If you're in Ghana, if you're in Nigeria, it's very advanced. If you're in some of the smaller countries, they're using typewriters at the borders to type out the manifests and the documents and the approvals. So we've done so much work to automate and digitize. That was the first generation of work. The second generation of work, we then connect those agencies at a country level. The third generation, we connect at a continent, at a corridor level. So for instance, the customs revenues, and I had a call this morning, the customs revenues in Eastern Africa are all connected right now. They can share a single customs document, and they're able to clear from the point of entry. If your goods come in from Mombasa, they are cleared all the way to Rwanda. If they come in from Dar es Salaam, they can be cleared all the way to Burundi with one single transit document. But it has meant that you have to ensure there's data sharing at the institutional level with all the customs at the national, customs at the border. You have to ensure there's connectivity with the bureaus of standards and anyone else related in trade, ministries of trade and the like. And then you have to ensure you're connecting with the others in the country and with the others in the other country. So customs in Tanzania connecting with customs in Rwanda, in Burundi, in Uganda, in Kenya, in DRC. It's taken us 15 years to get here. We cannot afford 15 years. We must do something different. And to congratulate our leaders, we now have a protocol, a digital trade protocol. It took its time coming, but again, it's the first of its kind, we are told, in the world. But for it to work, and Honorable Minister, you mentioned some of the things, for it to work, there are 5 things that I'm going to raise that I hope the panelists will speak to. The first, the political leadership and policy action that is needed to drive this protocol. We've heard of the need to align and to domesticate, to align national policies and to domesticate. I would have loved to hear today the ministers, and it's not too late, Honorable Minister, you're the one left here. I would have liked to hear some statements and actions around domestication and immediately what is going to be done before June by the parliaments. Of course, you cannot dictate what parliament does, but we can set the ground. We can put in place the steps. Because if we don't ratify and domesticate this protocol, we are in trouble. Remember, it's precocious. We have to immediately remove barriers to cross-border data flows. In my country, in Uganda, I can't use Facebook. I have to use a VPN. We have to remove these barriers immediately. I hope tomorrow or Saturday, when the ministers are launching, they make some pronouncements, bold political pronouncements around the removal of these barriers and freedom for free flow of data. For Africa to leapfrog, we have to let data flow. We have to let it happen. So for me, it's a political issue. Trade is very political. We must get these political statements out. Can you imagine if every time, say, President Trump makes an announcement, if our African presidents stood up and also made an announcement? We are removing visas. We are allowing free travel in Africa. We are removing border closures. We are opening up. Can you imagine what it would do to our population and to galvanize the whole continent? For those of us who are not yet still so young, it's time for our leaders to take action, and we have seen it happen in the past. The second, we must be worried. Not everything that glitters is gold. We are talking about time and cost to reduce business. We have so many businessmen and women that are taking initiative to go and do trade, but they are being hampered. Now, what's happening with digital trade coming in, we are having all these, I don't want to call them commercial vultures, but you're having everyone coming and promising gold, coming to say, we'll deliver to you scanners, we'll deliver to you single windows at a cost. It becomes more costly because they have to recoup their money. So my advice to you, how can we deliver digital trade and digital transformation without increasing the cost to the traders? You don't want someone to pay $100 to scan their goods at the border. You do not want someone to pay $100 to have their goods pass through the SWIFT. We can still deliver these at cost or with minimal cost. If you look at the WTO trader facilitation agreements, we must deliver these at cost. And as our digital expert at Trademark, Eric Sirali, always says, Alan, we cannot charge expensively. We just must make sure that we are delivering at cost or with very small markup. So ministers, policy leaders, be worried. Not everything that shines is gold. When people come to offer you solutions, make sure you're not making trade more expensive for your people. The third, and it's been said a lot, it has to be inclusive. It has to make business sense. We have to look at the MSAs, we have to look at the women, we have to look at the youth. At Trademark, we have created what we call an ISOCO, a digital market that's already operational in Eastern Africa. Over 100,000 traders are now trading on this portal. It's an Alibaba, it's an Amazon. I hope we can scale it around the continent. It allows for you to know who wants my goods, who is buying, who can I sell to. So my call to you all, can we go digital for trade? Because it's working. I mean, if you're in the US or in Europe, I don't know, people don't even go to the shops anymore. Very few people go to the shops. The older generation, maybe. The younger ones are all online. That's where our generation is. We must make it accessible. We also must make cross-border payments accessible. In East Africa, we're working with central banks. It's been slow, but it's happening. For cross-border payments, we are working with the Gates Foundation. We also have programs with MasterCard. You ask yourself, why are these guys coming here? They are seeing gold. Data is the new gold. It's not oil, it's data. They know that if we can allow people to trade, we'll actually make a difference. So if we can make it inclusive through cross-border payments that allow for one not to lose through currency fluctuations and transactions, can you imagine? I'm talking about the fish traders I've worked with in Eastern Africa who fish in Turkana in northern Kenya. They sell the fish at the border between Uganda and Kenya. They sell this fish as far as DRC, Chad, Tanzania, and Southern Sudan. And for each transaction, they have to be paid in a different currency. But through cross-border payments solutions, we should be able to get them paying through one. I'll quickly come to the last two or three. The fourth is data governance and security. Individual rights to protect their privacy without compromising, of course. We want to go commercial, but we have to protect personal privacy. And this is something that we are passionate about at Trademark. We recently did, during COVID, were able to register around, I think, 150,000 truck drivers because it was, most of the governments had locked the borders and they were not opening up. So we put in place a solution that allowed tracking of truck drivers along the transport corridors from, say, Kenya to DRC to South Sudan. And we put all their data in a system. And let me tell you, this allowed governments to trust, because at the center of trade is trust. Its ability to trace. And but we had to ensure that we fulfill EU regulations. Their data cannot be sold or shared. And finally, finally, is the rapid adoption of new technologies. My challenge to the panelists and to us all, we cannot afford 15 years of back-breaking build-up. We can adopt new technologies. At Trademark, we are working with partners to bring on artificial intelligence, AI, to take out blockchain technologies through innovations such as the Trade Logistics Information Pipeline. And later this afternoon, we are going to launch a new program, which I'll ask Frank to speak about shortly, called Twin, that is going to be the backbone of trade for Africa. We already have solutions that are working. Just imagine Kenya trades with Pakistan millions of dollars, but they do not trust each other's documents. But through these platforms, you have trusted frameworks, blockchain technology, data cannot be altered, certificates of origin cannot be altered, bureaus of certificates of standards can be altered, and this is critical as we trade within Africa and we trade with our partners. We are already deploying smart gates at borders, so no borders are becoming a reality. Smart gates are being installed at Dar es Salaam port, at Kenya Mombasa port, at the border between Uganda and Kenya. They have already been installed. Just by using technology, iris technology and the rest, you'll be able to get drivers going all the way from Mombasa to DRC without stopping. This is possible for transit cargo. Can you imagine? A whole new world awaits Africa. That means that you'll cut massive amount of time, days, and costs from trading. And then the final bit, how can we should we keep the status quo, or should we revolutionize the way we do business? It's a mindset game. I hope the panelists can talk about how we shift the mindsets of our people to adopt to these new technologies. We must align incentives and interests. In whose interest is it for business to remain as it is? In whose interest is it for business to change? I leave you with this question because no borders should be the way we move. For those of you who have traveled in Europe, you'll wake up in Poland and you will know you've gone through Germany, France, and the like. It's possible in Africa. It takes political will and commitment. It will need us to take and adopt new technologies. And as the Honorable President said, it's a precocious moment for Africa. Viva Africa!
Let me start with you, Liniani, if I may. And let's perhaps just begin with what you are doing, what you are working around. I'm not going to ask you to give background because we need to move fast, like we said, right? To accelerate the implementation of digital trade across the African continent. Ma'am, starting with Zambia, of course.
Thank you very much for that question. And good afternoon, Honorable Minister and the distinguished delegates. So I just want to emphasize that looking at the question that you have presented, we need to be able to know, do we have the goods that we want to trade as Africa? That's number one. And in having those goods, how do we facilitate access to affordable finance? So the financial system in this digitization is very important. Do we have institutions to move these goods? So having government departments have the necessary tools to facilitate the movement of goods and services is very key. And also to ensure that these systems are safe. Do we have the legal and regulatory frameworks to make sure that the goods are safe as they move? So issues were emphasized by our heads of state: trust, issues of security, issues of safe trade were emphasized during the previous session. So having said that, as Zambia, we have developed our border development strategy. We also have our e-commerce strategy with the hope that with these and other legal and regulatory frameworks that we have in place, like the cybersecurity related laws, we should be able to safely trade and contribute to accelerating AFCFTA. Most importantly is the inclusion of the private sector in this whole discussion. How do we make sure that they have the goods to trade? Thank you.
Thank you. Would you have some targets for me? One of the things I've been told to do today is to come back with targets that are measurable in terms of these objectives that you've just outlined.
Thank you very much. In terms of systems, in as far as government institutions are concerned, so the targets is to make sure that the payment systems are automated. The systems for certification are automated. We have systems that will allow smooth or seamless flow of trade, so we need things like smart gates. We need electronic payment systems. We need to make sure that we are connected to internet, so fiber optic connectivity becomes very important. We need to make sure that institutions are automated. We also need to make sure that systems are speaking across country, and issues of tracking of what we are trading. So if we are going to make progress, we need to make sure that we're tracking. And on the part of the private sector, is there financial inclusion? And what is the cost of this finance? Do they have systems that will help them be able to post their goods and somebody very far can see those products? So market platforms become key. And also the payment systems are key. So those are some of the priorities.
Thank you. Thank you very much indeed. Let me come to you, Frank. And Frank, it's pretty much the same question that I'm going to be asking as I'm going to ask all the other panelists at the beginning before we delve into the individual stories. So it's around trying to understand what key objectives from your side you hope digitalization will achieve in facilitating the increase that we require so that the agency that's been created by a reordering of the global trading order gives us some benefits.
I think it's the potential for this digital trade protocol to really be a game changer for the way that we trade across Africa is huge. And I think it extends in a number of ways. Alain, the Deputy CEO of Trademark, mentioned it, that the digital technology that now is there can help us reimagine the way that we move goods across borders, and we work with, we trade with countries within the continent. And I think it's very important to recognize that borders have always been a place, Godfrey, where you've got a physical barrier, and a physical barrier there in a way to try to stop trade, oddly enough. So the way that a lot of our borders are configured, the old way has been to create a physical barrier where the flow of goods can be controlled. But I think the power of technology is to change that completely. That you imagine the border not as a place where you stop goods, but the goods just move quickly, seamlessly, because they're backed up by a digital public infrastructure. They're backed up by different trade agencies being automated. As you said, PS, cargo tracking there, risk management systems, but most importantly, a digital public infrastructure that can support that. And there we're talking about digital IDs, particularly for the traders, basically very efficient cross-border data transfers, and then a payment system that operates right across the continent and operating on a platform that's seamless and open to all. So this is, I think, so if I was to think about what I dream about, this would mean that there's no border, all right? There would be a digital border that isn't there. It might be a border.
Frank, you need to say it again. Did you say you don't want to see any borders?
I'm sorry, what was that, Godfrey?
Did you say you don't want to see any borders?
I would love to see no borders.
Wow.
Yeah. But perhaps I'm being too optimistic. But the potential for a border to be reimagined with the technology we have, and actually the physical barrier not to be there, is within our grasp. I think some people call it a no-stop border. But in my view, the digital trade protocol, everything that's been done with the trade facilitation work that Demeter leads, it can happen, and it is within our grasp. We should do that. But it needs the political will that Alain talked about, and it needs us to focus on getting a good digital public infrastructure in place.
Yeah.
Because that underpins all of this. It underpins digital trade facilitation, digitally enabled borders.
Yeah.
And all of this will help unlock our trade.
I am certainly hoping that Alain will take a concept and take it across the continent so that our drivers do not need to stop. And as you say, if we can kill these borders, it's a game changer. I live to live that day, to see that day. I wanted to pose a question to you, which I'm going to ask and park and ask you to think about. You spoke about increased public spending to support some of these initiatives, but we also know that our governments are battling various other spending pressures at a particularly difficult time. How do we do it creatively without increasing the fiscal burden? I'll park that question with you and come to Gugu. Gugu, you are busy, you are trading, and you have dreams. This is your opportunity to spell out what you'd like to see digital trade doing.
Tumeza is a fintech, right, that provides early invoice settlement for the logistics sector. But the reason why I'm here today is to speak on behalf of our products, which is Tumeza Lite. So Tumeza Lite coordinates the movements of goods for cross-border traders. We handle the process for them end to end, from quotations, clearance of goods, as well as pickups and drop-offs. So as you can hear, this is a thankless task, I would say. It's one where you're constantly in conflict with drivers, with custom agents, and of course, sometimes with cross-border traders themselves. So the vision that I have, to be honest, right, I wouldn't say that it's quite as gigantic as Frank's one for a non-stop border future, looking at the fact that we're dealing with the barriers on a day-to-day basis. So I think my dream is a little bit more realistic. Just wishing for just simpler documentation. Because as you can imagine, on a day-by-day basis, we're based on the Zambian and Zimbabwean border posts, specifically Vicforce and Livingston. Not quite sure how many of you have been on that border. It's a little bit sleepy, but still does quite a bit of volume. So on a day-by-day basis, right, you're fighting with documentation. Today, moving tomatoes is free, it's easy. Tomorrow, the rules have changed, right? Imagine having to tell a cross-border trader that, so the quotation that I gave you yesterday is no longer applicable today. You've messed up this person's entire trajectory, and they're like, you've wasted my money, right? So the documentation, just the processing just needs to be simpler. The second one that I would say is just being predictable about what to expect on a day-by-day basis. I'm speaking to all of us in the room, especially if you've ever traded anything within COMESA, SACU, whichever it is. Predictability is the cornerstone for business. Once things are up in the air is when things start falling apart, right? And this is even before we start talking about payment systems. So I'm Zimbabwean, not quite sure how many of you are familiar with doing business in Zim. So my sister here next door is already like, I can commiserate. So moving cash for us across the borders is a nightmare. I think the Zambian cross-border traders have it a little bit easier with Airtel Money because they're connected a little bit within the continent. But for us, just moving cash across the borders is quite a bit of an issue. So the payments issue, I would say, is one that slots within my dream, right? So maybe for me not to hog the spotlight, because I will speak, till the end of time for this. In conclusion, I would say an end-to-end system that allows a cross-border trader to move their goods from the comfort of their home. As Nshuti has alluded to earlier on, that we heard from a cross-border trader from Livingston who had to come to Lusaka to get her goods and then go back home, leaving her daughter behind. That should not make sense in the 21st century. You should be able to handle all your trade from the comfort of your home, which I think is something that us at Tumeza were really trying hard to do. But as said, there are barriers to us being able to provide that vision for the cross-border traders sitting at home. Thank you, Godfrey.
Wow, thank you. Thank you, Gugu. I'm going to steal Standard Bank's, I think it was a payoff line a few years ago, and apply it to you. Simpler, better, faster. That's what you're looking for. And I'm also going to recommend that you give some advice to President Donald Trump about predictability. Felix, the turn is yours. You and I have engaged on several platforms. We've spoken about the work that you do. We've spoken about the challenges that you see across borders, trying to move goods from the eastern parts of Africa to southern Africa. Trade that is not happening.
For me, allow me today to speak as who I am. I'm a trader turned transporter, and now, ideally, they call me a techpreneur. But ideally, what I do, I move products. My main job is that I work with manufacturers, distributors, and suppliers to enable them or guarantee them of opening up a market base for their products in different countries with all the hassle of logistics, warehousing, market development, access to finance, and finally aspects to do with custom clearance and documentation. The future to me of what I'd like to see a united Africa looking like, I'd focus more on demand creation. I'd like to see a point whereby we can create demand using technology. The lessons I've learned in my transport and commodity trading businesses is that demand is the start of everything. If you can guarantee anyone that I'll be able to...
Join us at the African Development Bank Group's 2025 annual meetings from May 26th to the 30th in Abidjan, Côte d'Ivoire.
Every week, Africa's business landscape evolves.
And Africa Business Weekly is your inside access.
From industry trailblazers to policymakers and leading entrepreneurs,
we'll bring you the biggest business stories and the most impactful insights from across the continent. From the bustling hubs of West Africa
to the innovation centers in the East
and new market ideas south of the continent, we've got you covered.
With exclusive interviews and analysis to keep you informed.
Don't miss Africa Business Weekly every Friday.
Only on CNBC Africa.
Hello, it's 2 p.m. in Johannesburg as well as Cape Town, where the South African Finance Minister, Godongwana, is about to take the stage and attempt for the third time since February is a presentation of the national budget. He's been unable to do so the last 2 times because he did not have enough votes in the National Assembly to pass that budget. The hope is that today you will have the numbers and we're going to see that budget finally being passed through the National Assembly. Now, of course, all eyes are on the minister to understand how he is going to be finding the 75 billion rand that's required over the next 3 years to fund national commitments. Now, of course, we know that the minister initially proposed a hike in the value-added tax, which met political opposition, and he had to back down. There's no other word for it. And now we hear that there have been other plans that have been made. In the main, many economists are saying he has little choice but to bump up those sin taxes and also perhaps the fuel levy. At the same time, he will have to take a scalpel, if you like, to his spending plans, including those that may be national priorities and reduce national spending. All those questions are going to be answered in a few minutes when the minister takes to the stage to present that budget. Here on CNBC Africa, we, of course, will be watching this. You can also check our coverage on our website. That's www.cnbcafrica.com. We'll put as many of those stories that come through as we can. And then at the same time, we will also, of course, be talking to experts who has sifted through these numbers and make sense of these numbers, economists, fund managers, as well as analysts who look at these numbers and ask the question, what does it mean for economic growth? And we know around economic growth, the key question, of course, is around creating jobs. Jobs South Africa desperately needs. Now, of course, this national budget is being presented at a particularly difficult time for the country in relation to relations with its second largest trading partner in the world, the United States. The budget is being presented today without the presence of President Cyril Ramaphosa because he has taken some ministers as well as senior government officials to Washington for a meeting later today. The initial schedule I saw suggested that there was a meeting with President Trump and at about 5:30 p.m. Central African time, and we're going to try and see if we can bring you those pictures as well as that conversation if it takes place in the Oval Office. Now, of course, we know the Oval Office is where it all happened with the Ukrainian president, where he was given a very public dressing down by the president as well as the vice president of the United States. The hope is that for South Africa, it will not come to anything like that. So ahead of that presentation of that budget, let me bring you very quickly where the markets are, and they will be watching this very, very closely indeed to see what the finance minister is going to say about the numbers that South Africa requires to power economic growth in 2025. The rand has been strong to stable. So in the morning when we came in, it was just below 18 against the dollar. We've added a few cents. 17.89 is the picture that you're looking at on your screen, as you can clearly see. So stronger on the day against the US dollar, i.e. you need less rands to buy your dollar. So 1-0 to South Africa, I say, at least given on that. And then secondly is, of course, the stock market. The stock market, throughout the whole morning, we opened solidly in the black. We continue to be solidly in the black. I'm looking at my numbers now here, and what I'm seeing is a huge gain on the all-share index, and across the major indices, we are seeing strength, led by the resources sector. The resources sector, of course, we defer to gold because that's where the money has been going for the past few months. That's where the money continues to go. That resources 10 is up 2.9%. But there are also gains for the other sectors. Financial 15 is up. That's the banks and the insurance companies. And then we're also seeing gains on the industrials front. That's in the main, of course, process as well as NASPAS. That's up 0.5%. So strength, as I say, we're talking, in fact, record territory here, 820 points or almost 1%, 93,583. I've been talking, the minister is about to talk. Let's go to Cape Town and join this year's national budget presentation.
We simply can't extend the budget beyond the 30th of July because departments after the 30th of July will only be accessible to 10% of their budget. and none of the departments have got a 10% wage bill which is less than 10%. There are serious implications for that. It may mean that we may have to close government. Honorable Deputy President Paul Mashatile was also not with us for long commitments he undertook before this day was agreed upon. Cabinet colleagues, members of the Executive Council for Finance, Governor of the South African Reserve Bank, Commissioner of the South African Revenue Services, fellow South Africans. Allow me to table the following documents before this House. The 2025 Division of Revenue Bill, the 2025 Appropriation Bill, the 2025 Estimates of National Expenditure, the revised information on the 2025 Estimate of National Expenditure, the 2025 Budget Review published on the 12th of March and tabled here as a key policy reference, update Annexure A of the March 2025 Budget Review, update statistical annexure to the March 2025 Budget Review, the 2025 Budget Overview, and the 2025 Budget Speech. The documents tabled here today are additional to the bills previously tabled, namely the 2025 ESCOM Debt Relief Amendment Bill, the 2025 Public Sector Pension and Related Payments Bill, the 2025 Revenue Laws Amendment Bill, the 2025 Rates and Monetary Amounts and Amendment Revenue Laws Bill. Madam Speaker, before I can proceed, I must say even Dr. Kairam Hopper has accepted that the victory of Kaizer Chiefs is of national importance.
Order, honorable members, don't divide the House. The game was a very good game. Let's not talk about the scores. Let's proceed with the budget.
Madam Speaker, a national budget is not merely an accounting exercise measuring what we earn and what we spend and what we borrow as a nation. It is a reflection of the difficult trade-offs needed to balance fiscal sustainability while simultaneously addressing the developmental goals. It is unsurprising then that the increase to value-added tax proposed on March 12 created so much debate. A vital debate, no doubt, but one that also created some uncertainty. There's clarity now that will remain at 15%. The decision reflects our commitment to listen to South Africans and to all the political parties represented in this House. Today's budget has taken these views into account. This is what the past 2 months have provided, valuable lessons that will inform how we manage the budget process moving forward. The reality, however, is that the decision to do away with the VAT increase without a viable alternative source of revenue significantly reduce our ability to fund additional government programs and projects to the extent we had deemed necessary. It directs 61% of every rand of consolidated non-interest expenditure towards the social wage. This is money that will be spent to fund free basic services like electricity, water, education, healthcare, affordable houses, as well as social grants for those in need. This budget invests over 1 trillion in critical infrastructure to lift economic growth prospects and improve access to services. Madam Speaker, this is done without compromising the fiscal strategy of sustainable public finances. We have achieved this difficult balance by reducing additional spending over the medium term by 68 billion rand. Let me repeat because there's confusion. We are saying by reducing additional spending is not cutting budget. There's a difference between the two. There's a difference between the two. What we've been fighting over these 3 months has been by how much we should increase budget, not by how much we should be cutting the budget. So what is being reduced is additional spending. These reductions are primarily aimed at provisional allocation, not yet assigned to votes. Simply put, this means baseline allocations across all spheres of government remain largely unchanged. Instead, the size of the proposed increase to allocation is reduced in line with what we can afford. Our focus going forward is threefold. Our focus, as I've indicated, is threefold: balancing the budget through spending efficiencies, strengthening revenue allocation, and giving expression to the medium-term development plan. This undertaking is not insurmountable if we work together, stay focused, and persevere to chart a better course for our economy and our people. Turning to the economic outlook, Madam Speaker, much has changed